we launched our first active ETF about 8 years ago, and I think we were one of the innovators, particularly in fixed income.
All right, joining me will be Greg Stumm, CEO of American Beacon Partners, who, in a nutshell, they work with investment managers to handle a lot of what goes on behind the scenes in order to help their products be successful. So things like distribution, back-end operations, administrative services, a lot of the aspects that can help investment managers operate their products more efficiently and certainly foster growth. And so, for example, they handle distribution for the ARK Invest ETFs. They're helping ARK get their products into the hands of investors and advisors. They also have an ETF focused platform where they partnered with a Man Group on two ETFs. There's also another ETF they partnered with Ionic Capital Management on. But because of this role that American Beacon occupies, if you think about this, that gives Greg a front row seat to everything occurring in the world of ETFs, right? He can see emerging trends. He knows what's working, what's not working. And importantly, he can see this from both sides, both the asset manager side and also from the investor's perspective. And so this should be interesting because we're going to find out what he is seeing right now, some of the key trends he's tracking in the ETF space. And he'll also tell you more about the role of a company like American Beacon as well. Now, later, I'll be joined by Jason Greenblath, Senior Portfolio Manager and Director of Corporate Credit Research at American Century Investments, who's a top 15 ETF issuer, really not that far away from knocking on the door of being a top 10 issuer. They have 17 ETFs under the American Century brand. Those have about $5.5 billion in assets. And then they also offer the Avantis ETFs, which that's another 30 ETFs with nearly $88 billion in assets. So you can do the math here and see that they're at about $93 billion overall. Now, Jason is lead portfolio manager on three American Century fixed income ETFs, all of which are actively managed. And so we are going to have a fairly in-depth conversation around active fixed income ETFs overall. We'll talk about what's been driving the growing interest here. I want to hear how Jason lays out the value prop of active management in fixed income. We'll find out exactly where he's seeing opportunities right now. This should be another interesting conversation in an area that I think is challenging for a lot of investors right now, trying to figure out how much credit risk to take, duration risk to take, those sorts of things. So again, he'll join me later. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. Okay, so let me now welcome in Greg Stumm, CEO of American Beacon Partners, who is joining me from Dallas. Greg, welcome to the podcast.
Hey, thanks so much for having me. Excited to be here.
Okay, so I just gave a quick snapshot there in the opening, but I want to start by having you talk more about American Beacon Partners before we dive into some other ETF topics. I guess, did I hit the high points there? What else would you add to my description?
No, I think you hit the nail on the head there. I think we like to say internally is we have three core competencies and one benefit for our client base. And when I say our client base, I think both investors and boutique managers, and that benefit is scale, right? And so when you think about what are our three core competencies, it's manager identification. So we talk to over 200 different specialty boutique managers a year, trying to find kind of the best of the best to build a really curated, unique list of investments. Our second core competency is product optimization, so helping develop truly active ETFs or private markets funds, et cetera. And then lastly, client service, specifically within the U.S. wealth and retirement spaces. And so when you think about kind of the way the world's going, unfortunately, it's becoming really hard to compete if you're a boutique manager, right? You may do one thing, you may do it really, really well, but without scale, it's hard to run products efficiently. It's hard to get shelf space. It's hard to market and get your name out there. And what we do is we find those great boutique managers and we give them all the scale that they need to be successful and get their ideas to retail investors and financial intermediaries that maybe wouldn't be able to access them without our partnership. And so we're excited about all the innovation that's happening in the market today, because it really plays to our strengths of finding great managers and being able to really democratize their access to the wealth market.
And just to go into a little more detail there, I mentioned your ETF platform at the top. Talk more specifically about that.
Yeah, so as you mentioned, we do have the American Beacon ETF business today. We have three ETFs on that platform, and they're all sub-advised, right? So what that means is I kind of joke around and say we do everything that the managers don't want to do, right? So we do all the ops, the administration, the compliance, the marketing, the distribution, and they provide the investment expertise, right? So whether it's natural resource equities or trend following or inflation hedging, or international investing, et cetera, they can just focus on their core competency, which is running a portfolio to generate alpha for investors, and we handle all of the other aspects of it. And the really interesting thing is we don't have typically economic interest in these sub advisors. We're just looking for the best ideas. And so, from an investor or a financial advisor standpoint, I mentioned that word scale before. Like they look at us, Nate, as an extension of their research, right? We scale them up because we're talking to hundreds of managers, so they don't have to. And they know if someone's on our platform, not only do we do initial due diligence, investment due diligence, operational due diligence, we're also doing ongoing due diligence. So our asset management team is talking to these sub-advisors every quarter to make sure, hey, are you doing what you're supposed to be doing? Are you still following our investment processes? Are the people in place there? Is the compliance in place? And so to have all that kind of extra oversight and diligence resources really kind of helps scale up investors as well.
I noted that you handle distribution for the ARK Invest ETFs. Can you talk more about what that entails? I think most people understand distribution, but I'd love to have you explain that further.
Yeah. So I like to say we take complex ideas and simplify them. Right. Kathy Wood and the team at ARK for over a decade now have been a leader in investing in disruptive innovation. Right. Whether that is cryptocurrencies, multiomics and CRISPR technology, 3D printing, space exploration. I've had to learn so much in the last 10 years just to keep up with them. It's amazing. But what we do is really help investors think about, okay, why would you want to invest in innovation, right? What does that look like? What does the long-term return profile look like? How do you think about it within the context of an asset allocation, right? Because you're not just buying this for 100% of your portfolio. You shouldn't be buying it for 100% of your portfolio, right? It needs to be thoughtfully put in an asset allocation mix. And so how do you do that, right? Where do you take the funds from? How do you think about optimizing that for different clients, right? You've got a client that has a higher risk profile or a client with a lower risk profile. They should all have access to innovation, probably just in different ways and different exposures, right? Nate, the other thing we think about a lot from distribution is the behavioral aspect of this, right? I've had the privilege of going through both the CFA and the Kaya programs, and we spend a lot of time thinking about MPT and alpha and beta and all these cool metrics. The emotional side of it is really important as well, right? And so making sure people kind of understand these technologies, these innovations, how they are impacting the world and the future and our children's worlds, and really think about investing not just for our own benefit, but for the benefit of the future of the civilization, of our species. And understanding that in the context of investing too also helps in some more volatile type investment strategies, right? Where you need to take a 7, 10, 15-year view when you're doing this. You can't look at it every month or every quarter, and if you do, it's probably not the right investment for you. So I'll pause there, and hopefully that answers your question.
No, I love that. And, as you describe that, I think because of the space that American Beacon occupies and being involved in things like distribution and everything else that you noted, I do feel like you have a front row seat to everything occurring within the asset management industry, just in terms of being able to identify emerging trends and understand what's working, what's not working. And so I want to ask you some questions specifically around that. Let's get into some ETF topics. And, as you explain your role with ARK Invest, I want to dovetail on that by talking more about distribution. And you were alluding to some of the challenges here, especially for smaller or more boutique managers who are entering the ETF space. And as you know, we have seen a lot of new entrants that are obviously trying to get their products in front of investors. And so talk about some of the key challenges here. I think this is a real pain point for a lot of new entrants.
Yeah, I think there are a number of pain points, and I think what we're seeing is there are a lot of people with a lot of great ideas out there, right? Like the big ETF issuers have some great ideas, but there's also a lot of boutiques that do things well. And what I'm excited for, we talk about the growth of the truly active ETF, right? Where you've got active managers that are running very high conviction portfolios that are trying to generate a significant and sustained alpha over a cycle coming to the ETF market. Now, we've had a few of those. Obviously, we mentioned Kathy. I mean, she's about as active as you can be. But there has not been a huge proliferation of these, right? There's been a lot of really interesting ideas around kind of options exposure or more factor based exposure, but we're just in the infancy, we believe, of these truly active ETFs. And a lot of these active ETFs are run by boutique managers, right? Because again, you're a specialist, right? So like, we work with a firm on the West Coast that does one thing and does it really well, which is high yield bonds, right? That's all they do, and they're a specialist there. And so when you think about a boutique manager that's a specialist wanting to bring their active strategy to the ETF space, there are a number of hurdles, right? And the biggest is scale. It's becoming increasingly more expensive and harder to, simply like conduct the compliance and diligence work that you need to do, but also to get both shelf space on advisor platforms and mind space for advisors as well, right? Like, one of my first mentors, what he said to me is the most valuable commodity is time, right? It's one of the few things we can't get more of, no matter how successful we are. And when you talk to a lot of financial advisors and investors today, they don't want to work with 25 different firms, right? It's too much of a drag on their time to work with 25 different firms to get their research, to understand their products, etc. They want to work with, call it 6 to 10 firms, and they can be true partners of, and they can leverage their research, their asset allocation work, product optimization, their investment work. And if you've got a boutique and you do one thing, you do it well, you're typically not going to be one of those firms, right? You're not going to be able to bring enough resources to a financial advisor or an investor to really kind of help with their scaling up their time. And so it's becoming harder and harder for them to get shelf space on the platforms, but also to get mind space of the financial advisor because they don't have the breadth of products and the scale and the resources to support that investor.
So, with that said, what do you think is the recipe for success for an active manager? What does American Beacon look for in an active manager? Because it is increasingly difficult to stand out. So what's the recipe for success here?
Yeah. So one, I would say if you're a great active manager, partner with us, right? Because we bring that scale that a lot of these boutiques um, need, but we also they maintain their total autonomy, right? Like they're still an independent firm. They have their investment thesis, they're running the portfolio. We're just taking care of all the things that they're struggling with, right? So I think the partnership really helps. But what I would say is be differentiated, right? There are a lot of products coming to market today. I did an interview last week about all the copycat products, right? And if your strategy is easily replicated, you need to have a different strategy. If you're going to be truly active, it should be driven by your fundamental investment research, both on the top down and the bottom up. You should be running high conviction portfolios, and you should be accountable for delivering long term alpha to clients. And so that's what we're looking for. And the other thing is we're looking for managers that are willing to do it in spaces that haven't necessarily been willing to do it before, right? And so, like, I'll give you a couple examples. Trend following, right? Like we talk about liquid alternatives all the time. That was the really kind of mutual fund only access until the last couple of years, and now you've seen an expansion of more liquid alternatives in the ETF space. Fixed income. I know your guest after me, Jason, is going to talk about active fixed income, truly active approach to fixed income investing in the ETF space. That is a new frontier, right? Like we're seeing more and more of that now. And so I would say have this willingness to do that. I will throw one little asterisk in there, Nate. And I know this is an ETF podcast, but I've been quoted saying the death of the mutual fund is greatly exaggerated. A good strategy is a good strategy, right? And there are some strategies that should be and are extremely capacity constrained. right? And one of the biggest challenges of an ETF is you can't close a strategy. So, we've identified 5 or 6 or 7 strategies that really can't run $20 billion or even $10 billion or maybe not even $5 billion. And so they're in a mutual fund. They should not be in an ETF, right? And so, like, if I was investing in an ETF today and I found a great differentiated manager, one of my questions would be, what is the give up because of the lack of capacity constraints that you have here, right? You cannot limit your capacity. And what is my give up there? And really, again, like I said, understand ETF is a great wrapper. Is this the right strategy for me in that wrapper?
Well, and I'll actually flip that around and say that the ETF wrapper can't magically transform a poor active strategy or a poor active manager into something better or into outperformance, right? It's not
No.
a magic potion to figure out how to outperform. But with that said, I'm curious. We're talking about mutual funds and ETFs. As you know, we have the forthcoming multi-share class structure, which actually the SEC just issued an approval order for Dimensional yesterday, and so they're going to start bringing that to market. And right now we have, I believe, nearly 90 asset managers that are looking to offer ETF share classes of existing mutual funds or vice versa. And I've heard a lot of chatter around a number of things. One, that distribution could be a real pain point here, just because maybe some asset managers don't have that figured out on the ETF side. But also, I think going back to what we were just talking about, we're going to have a parade of new active ETFs out there for investors to wade through. And I do have some concerns around how they do that. How do they differentiate between these strategies? And so, any thoughts on either of those topics?
Yeah, so I'm going to go back to what you said there, Nate. Is a bad strategy and a good wrapper is still a bad strategy, right? And what we have not filed for an active ETF share class. We may at some point, but when we look at it today, most of our funds that are growing are capacity constrained, and we don't feel it's appropriate to offer an ETF wrapper of a strategy and dilute that strategy because of the capacity constraints of emerging market fund or a multi-sector fixed income fund or a high yield fund, right? And so what I think we want to be really careful about is taking strategies that weren't raising money because they weren't necessarily great strategies or they weren't truly active, right? They've got hundreds and hundreds of securities in there, and or maybe they're kind of like factor based, et cetera, and just putting them in ETF wrapper like that. That is what it is. But what we're really want to prevent is diluting super high quality active managers that are capacity constrained, diluting their process for our mutual fund shareholders by being forced to offer an ETF share class of that and then having to change the strategy, right? And so I think, again, this comes back to this idea of capacity. It comes back to the fundamental question of can this manager generate sustained and proven alpha? Like we like to say, does the strategy make economic sense? Is the process definable, repeatable, proven over time? And if the answer is no, like I don't care what wrapper it's in, it's irrelevant. And then to your point, I think it creates a lot of confusion, right? What is the best share class? The management fee is the management fee. There's no changing the management fee in an ETF share class or a mutual fund share class. It's still that, where, and like what we're seeing now is a lot of our retirement plan clients are using collective investment trusts, which might even actually be cheaper than an ETF. And so I just, again, I take a step of caution there and just want to be thoughtful about what we're doing and just saying, I don't need to launch an ETF share class just because it's the cool thing to do. Although we like doing cool things from the investment side.
All right. While we're talking about what does and doesn't belong in an ETF wrapper, I want to close here by asking you about two ETF topics that have been very, very popular this year, but also generated a lot of debate. And that's private credit or private equity in an ETF wrapper, and then crypto. So let's first start on the private credit and private equity side. What are your views on whether or not that belongs in an ETF wrapper, and any other considerations?
Yeah. So, I mean, Nate, we talked about kind of our second core competency as product optimization, right? Um, so it's find a great manager and put them in the appropriate product for the strategy and the shareholder, right? I think what you're seeing on the private markets on the ETF side today is really just public market ETFs that are owning a little bit of private markets in there. They're sprinkling it in, right, to say they've got some private markets. And so you're probably paying more for the whole package than you would have if you would buy a public markets ETF and a private markets evergreen fund if you're accredited, et cetera, or an interval fund or something else. And so our preference is to say, like, just as opposed to just saying, okay, I need private markets and I'm going to get this ETF that's got a little bit in here and probably overpay for it or not get the best manager. We would say is, like, buy your liquid securities in an ETF or a daily liquid format mutual fund, et cetera. And if you're going to buy private markets, like, buy them in the appropriate vehicle, right? And what's really interesting, Nate, not to go off another wrapper than ETF, obviously evergreen funds are the, vehicle of choice, right? Like, everyone wants to be in an evergreen fund, whether it's an interval fund or a tender offer fund or an LP structure. Sometimes evergreen's not right either, right? Sometimes the traditional kind of old school drawdown vehicle is appropriate for the investment strategy. And so, we've kind of done a lot of pushback on that and said, yeah, evergreen's great for the appropriate strategy, but not necessarily. And so, like, that would be my caution anyway, is, like, just if you're going to get exposure to that private markets, there's a lot of great ways to do it, where you're picking specific managers and skill sets and you're allowing them to optimize their strategy. And yes, it's less liquid, but we would prefer to do it that way.
A few minutes left here. What about crypto ETFs? We talked earlier about ARK Invest, who obviously offers several crypto-related products. Do you see American Beacon getting more involved in this space, or do you have any other thoughts around crypto?
Yeah, I mean, obviously, we've got a wonderful partnership with ARK. They are our crypto experts. Every time I have a question on blockchain technology, I pick up the phone and call St. Pete, Florida, for some advice. And so I would expect our expansion in that to be through our partnership with ARK. I know they've got long-term strategy there. But again, I think primarily around active solutions, different ways to derive value for clients within the crypto market. But yes, I would expect more from that. A big part of that, Nate, we talked about the benefits of distribution before. There are a lot of financial advisors that are not allocated to crypto today. They really don't understand it. And so we spend a lot of our time just educating people on the benefits of it, how to implement it in a portfolio. And rightfully so, if you're an allocator, you should be thoughtful about, why am I buying this, right? You can't just buy it because a lot of people talk about it on X, right? Or clients are asking for it. A lot of times clients ask for things and we have to do what's right, not what's easy. And so you've got to make sure you understand the benefits of it. We talk a lot about the benefits of investing in Bitcoin as a store of value, as a universal transfer of wealth system. And there's, ARK has done some amazing research, and Kathy and the team have put out some great white papers on why. But we also spend a lot of time thinking about, where do you get the money from, right? Like, the volatility profile of it is different than traditional investments. How do you think about that from a portfolio optimization standpoint? And so our focus has been, yes, we believe in crypto. We've got a great partner in ARK that's doing a ton of innovative things there. We've got to educate advisors on why to use it and how to use it, to make sure we have the proper client experience at the end of the day. Because that, we talked about institutional quality. We also spend a lot of time thinking about enduring value. You have the greatest strategy in the world. If a client can't own it to benefit from the return profile, it's useless, right? And so we really need to make sure we're delivering the education and the profile and the vehicle that delivers the most enduring value, to make sure these clients get a positive experience when partnering with us.
I could not have said it better myself. I think it always comes back to education, really, on everything that we've talked about here today, whether it's crypto, private assets, active management. It does come back to understanding what's going on behind or underneath the hood, and how it may benefit a portfolio. But Greg, really interesting conversation this week. I always love hearing unique perspectives in the ETF space, which you obviously can provide. So thank you for that, and thank you for joining me.
No, it was a pleasure. Thanks so much for having me, and hopefully can join you again.
That was Greg Stumm, CEO of American Beacon Partners.
Markets are always evolving. The Whole Tactical US ETF HTUS uses quantitative models to tactically adjust exposure to US equities on a daily basis. It's about adapting with discipline. Learn more about HTUS and how it can complement your investments at wholetacticalfunds.com. Carefully consider the fund's investment objectives, risk factors, charges, and expenses before investing. This and additional information can be found in the fund's prospectus, which can be obtained by visiting wholetacticalfunds.com. Read the prospectus carefully before investing. The fund is distributed by Northern Lights Distributors, LLC. Looking to put idle cash to work? Discover AMUN, Aberdeen's ultra-short municipal income ETF, designed for high after-tax income and capital preservation. AMUN targets muni market inefficiencies with disciplined risk management. Invest smart, stay short. Learn more at aberdeeninvestments.com/active-ETFs. AMUN, where short-term meets smart strategy. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. To obtain a prospectus containing this and other information, please call 1-844-383-7289. Read the prospectus carefully before you invest. Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Jason Greenblath, Senior Portfolio Manager and Director of Corporate Credit Research at American Century Investments, who currently offers 17 ETFs under the American Century brand. Those have about $5.5 billion in assets. And then, of course, also under the American Century umbrella are the Avantis ETFs. That's another 30 ETFs with nearly $88 billion in assets. So quickly approaching $100 billion overall. And Jason is lead portfolio manager on 3 of the American Century branded ETFs, all active fixed income ETFs. And he's now joining me from New York. Jason, welcome to the podcast.
Hi, Nate. Great to be here with you today. Thank you for inviting me.
All right. So for listeners, if my introduction didn't give it away, obviously we're going to focus on fixed income and fixed income ETFs. And Jason, I thought let's start bigger picture. So I was actually just discussing the growth of active ETFs overall in my previous segment, which I think this has been a well-documented story in ETF land over the past several years. But I always love hearing different views on that growth. And so let's start there. From your perspective, what do you think has been driving the growth of active fixed income ETFs in particular, which of course is your domain?
Yeah, I think it's a great topic. So we launched our first active ETF about 8 years ago, and I think we were one of the innovators, particularly in fixed income. And I think if you go back roughly 3 decades, right, since ETFs were developed, a lot of it was, let me get exposure to the S&P 500 in equities. Let me get exposure to the US ag in fixed income, something that gives me a benchmark exposure. But I think that from our experience and from speaking with clients, there's more to it than that. There's more desire to have thematic exposure within fixed income. Some may want high yield, some may want emerging markets, some may not want 8+ years of duration in LQD, one of the largest indices out there in ETFs and fixed income. They may want more specific exposure. I think that in conjunction with, there's a lot of fixed income out there. Fixed income that fits into the ag, looks a lot like treasuries. It's treasuries and mortgage-backed securities with some investment grade corporates for about the 25% of the index. The other, call it 75%, is U.S. government-like debt. There's got to be more fixed income out there than just what's in the benchmark, and that's what I think ourselves and our competitors are after is what else is out there beyond just investing in an index that's really treasury or government-like.
So if you were to paint the value proposition for active management and fixed income, is it that the ability to sort of go wherever? I guess I'd love to have you go in more depth here in terms of what specifically an active manager can bring to the table in fixed income.
Sure. So to state the obvious, fixed income typically has a final maturity, right? Most debt does. 30-year mortgage could be a 5-year corporate bond, could be a 7-year high yield bond. When those bonds come due, or perhaps earlier, if there's an event, for example, mergers and acquisition activity, may require a company to refinance their debt early. Because of that, there's a very active component to what we refer to as the primary market. That's where companies come, they work with their underwriters to issue new debt. That new debt doesn't go into the index until the end of the month. For active managers like ourselves, one area where we can add value, one area where we're active, to state the obvious, is we can participate in new issues. Your listeners may be aware that new issuance is a significant part of the fixed income market. We're going to issue 1.6 trillion dollars of U.S. dollar denominated investment grade corporates this year, 300 plus billion dollars of high yield. We can go in, we can buy that before the index buyers have to buy them before they go into the index. Maybe we hold it, maybe we don't. Maybe we're just clipping a new issue concession. That's one small part of what I would call the active approach. The other is we find fixed income generally mispriced in a lot of different ways. So for example, if you're looking at the S&P 500 on your equity portfolios or indices, there's 500 companies, 500 stocks, right? In investment grade US dollar denominated corporates, there's over 7,000 bonds, close to 800 issuers. So a lot more companies and a term structure for us to consider. Then think about companies that could migrate up in ratings quality, migrate down. Sometimes they go down to high yield, could be in a crossover space as we refer to it. Oftentimes those are kicked out of an index because maybe they've lost 2 out of 3 ratings, but they still may have an investment grade rating on one side. That could be an opportunity for active managers to take advantage of, where it sort of falls into what we refer to as no man's land. So because of these index dynamics, the rules around indices, when new bonds come in, when they come out, activity such as mergers and acquisitions, there's a lot of activity for us as active managers really to sink our teeth into to find mispricings. And despite, which I'm sure many of your listeners are aware of, despite rich or tight valuations in index levels today, when you look below the surface, these opportunities are coming to us daily. I find that amazing. I said that to one of my colleagues yesterday who's in town from our London office, and I said, despite the fact that we're at generational tights and high yield and investment grade, the fact that our team can come to myself and to other portfolio managers on our team and say, hey, I found a great opportunity. This is a rising star. It's a 5B, meaning it has triple B on one side and double B on the other. It's going to become investment grade in the next 6 to 12 months. That's an opportunity for us to find something outside an index where spreads will continue to tighten and the total returns, in our opinion, are very attractive.
I think your last point is a good one, and I do think it's a good way to highlight the potential value of active management. And let's talk more about that and just the broader fixed income markets overall. And Jason, I continue to talk a lot about what I call the fixed income conundrum. And I think this is pretty straightforward, certainly for somebody like you. But the way that I typically lay this out is when I visit with investors and advisors, I come across a number who are still very hesitant to take on any duration risk. Okay, there's still some fear over inflation, and I think you could even work in the country's fiscal situation. The bottom line is they just don't feel comfortable taking on longer term rate risk. And then to what you were just speaking to on the credit side, I think there are some concerns that perhaps the economy is slowing, and you do have credit spreads at historically tight levels, and so there's just not much appetite for credit risk either. And so what I see is many investors and advisors, they're just throwing up their hands and they're saying, I'm just going to park in shorter duration investment grade ETFs or money market funds, those sorts of vehicles. I'm curious, how do you think about that? Maybe the pros and cons of just throwing up your hands right now.
So I think this topic came about in full swing, I would say mid-year to maybe the second half of last year as the Fed started cutting rates. What should I do with my cash? I'm locked in, I'm rolling T-bills. Should I move out to a short duration strategy, maybe 2 years? Should I go a little bit further out to 5 years? What do you think about going further out the curve? So this topic is, I would say has been on a lot of folks' minds, in my opinion, for a while. Our recommendation is we want to lock in some yield today. We want to lock in 30-year yields and be stuck in the long end of the curve? No. I think that there are risks as we look out to 2026, for example. Um, we could be in a growth environment, could be an environment where the Fed's cutting rates. Perhaps there's more stimulus money that's being handed out to consumers, and the economy is going to run hot. Well, that could be an environment, to your point, Nate, where inflation is also running hot. And what's going to happen? The curve is going to steepen, and you could see higher long-term interest rates. So one of our views, and you sort of teed this up for me, I appreciate that, thank you, is being short the long end of the curve. Why? Because we think that it's vulnerable to a reinflation scenario. So where to go? I think if we look at the front end of the curve, the 2 year is probably more hinged to what happens with the Fed. You extend out maybe to 4 or 5 year strategy, call that an intermediate term duration strategy. I think you're still locked in and earning attractive carry. I think there are attractive credit opportunities, as I was alluding to before, with some of these names and opportunities below the surface, below the index level um, space. So that's kind of, in our opinion, the sweet spot is sort of in the 2 to 5 year duration. You're still earning attractive yield. And I think that that's generally where we're finding opportunities. Then couple that with what I was alluding to before with tight index valuations. The last thing you want to do is buy, in our book, we don't want to buy a 30-year investment grade corporate bond for carry. There's a losing strategy. It's a losing strategy because if you think about the bond math, and I'm not going to geek it out too much, but if you think about it, long duration bonds have a lot of interest rate risk. Well, long duration bonds also have a lot of credit risk. And if credit spreads, where if you're in a 10-year investment grade bond and you extend out to a 30-year, there's a lot more interest rate risk that we refer to as spread duration, meaning that as credit spreads widen or they contract, they also have a big influence on the price of those securities. So we don't want to be sort of hanging out in the long end of a credit curve, whether it's in mortgages or corporate credit. We want to find opportunities where spreads are going to tighten. So you will find us, just full disclosure, if any of your listeners are looking through our portfolios and saying, hey, Jason said don't own the long end of the curve, but I see in their portfolios they have long bonds. Well, we want to own those long bonds that are hedged. So we'll use Treasury futures to basically negate the rate risk. And we're making a bet that credit spreads would tighten. So there are opportunities further out the curve opportunistically. I don't want to say that there's nothing to do, but I think really you need to think about your interest rate risk when talking about longer duration debt. Again, back to the beginning of the curve, 2 to 5 years, you can earn 5 or 6% in yield. With credit spreads being at generational tights as well, you have less spread volatility that will impact the price of your bonds, provided you've done your homework. You're not talking about a default or a restructuring situation. The prices should revert back after some bouts of volatility. If and when there are bouts, there are going to be, and there have been, that your spread should revert back and your bonds should pay off at par. So again, I think that when you're in this tight environment, an uncertain growth slash inflation environment, I think your listeners should really be, considering something in the front to intermediate part of the curve.
With some of those specific opportunities you just walked through, I think you're probably aware there's something, last I checked, like $7.5 trillion parked in money market funds. And obviously here over the past several months, those yields have come down. Now we'll see what happens moving forward. As you were mentioning, perhaps growth could reaccelerate, the Fed's going to pause. We don't know exactly how that's going to play out, but do you see some of that money in money market funds gravitating towards some of the opportunities that you just mentioned? And could that also be a positive catalyst for some of those areas?
I think so. I think that some of the money market funds, that the flows, and we see it too internally with reallocation of multi-asset portfolios going from credit into cash or cash back into credit. Yeah, taking some chips off the table. I've seen some de-risking, and you could see some of that flow back in. But I think it, honestly, Nate, I think it extends well beyond just the 7.5 trillion that you mentioned. With higher rates, there's a lot of underwriting of insurance policies. That those insurance policies, the proceeds we see show up at our front doorstep daily, buying risk. Back to the long end of the curve. When 30-year investment grade corporates reach 6% in yield, they're roughly 5.75% today. So if we get some backup and some widening or higher back end treasury rates, you're going to see insurance buyers step in. Pension buyers as well, locking in these higher rates. And I think what we've seen as well is the depth of the U.S. dollar market has also provided a lot of opportunities for foreign buyers. But I think that the point is there's a lot of debt outstanding, over 7 trillion in IG US dollar. Um, I think there's 20 odd trillion when you start to look at some of the indices. There's really a lot of depth to the market, and I think that depth, coupled with higher rates that we haven't seen for quite some time, that we've seen over the last 2, 3 years, has really attracted a lot of new entrants into the fixed income market, which also will keep spreads and I think yields under control because of that gravitation towards locking in rates here.
In terms of other potential areas of opportunity, I have to ask you about private credit. As I'm sure you're aware, private credit and ETFs, that's been a big story this year. It's garnered a lot of attention. But, here recently, there has been some turmoil in that space. Any strong views here, whether positive or negative, and any thoughts on wrapping private credit in an ETF?
Yeah, yeah. So I was listening to your prior guest, and I have similar views. There's the right wrapper for private credit if you're a believer in private credit, um, probably outside the ETF world. But think about why investors come into ETFs. They want daily liquidity, they want visibility into pricing throughout the day, pricing of the underlying assets, and in a tax efficient vehicle. When we in my team invest in multi-sector portfolios, whether it's securitized, mortgage-backed securities, corporates, high yield investment grade, emerging markets, there's transparency and liquidity into the pricing of the underlying securities. I would challenge those who are in the private credit world to say, give me a real mark and provide that to me throughout the day. Then layer on top of that the strategies and the tools and techniques that we use to help our active approach of also managing ETFs and the underlying assets in a tax efficient manner. Our clients generally don't like or do not like distributions at the end of the year. So throughout the year, we're working are the mechanisms that we have to generate losses to offset those gains. I don't know how you do that in a private credit environment. But again, I think to the transparency. What happens when you have a create, meaning that someone goes out and sells a unit of an ETF and the underlying assets or private credit? Do you just go out and say, all right, well, I have one bond, one client that's my investor and that I'm lending against. How do I create more shares of that same asset? You have to go and create more loans. I just don't know how readily available that is in an ETF wrapper, right? So inflows, outflows have an influence, in my opinion, on the ETF world and private credit investing.
Yeah, you hit on all of the concerns that I have mentioned over the past year. When you start talking about how you value the holdings, certainly the underlying liquidity, you mentioned the potential tax efficiency or lack thereof. And it'll be interesting to watch going forward because investors thus far aren't really jumping in with both feet either, at least in the ETF side of the equation. So I think all of that points to, I think there's clearly some questions around whether or not private credit in ETFs makes a lot of sense. Um, I want to talk more about the ETFs that you specifically manage. So you're the lead portfolio manager on 3 ETFs. And let me rattle those off. So those are the American Century Diversified Corporate Bond ETF, ticker CORP, KORP. the American Century Multi-Sector Income ETF, ticker MUSI, and then the American Century Short Duration Strategic Income ETF, ticker SDSI. Do you want to offer a quick snapshot on any or all of those? I'll just let you go wherever here to talk about those three ETFs.
Sure, sure, absolutely. Thank you. The first one you mentioned, KORP, Corp. And so that's, as the name suggests, it's a corporate ETF, intermediate duration, so it fits with our recommendation. Predominantly investment grade corporates. And I say predominantly, we can go from 0 to 35% in high yield. I think that that gives us a band of and a range of opportunities to capture, as I was alluding to before, some of those crossover names that may be rising up, that may be mispriced, sometimes some double Bs, for example, high quality, high yield that we may be working with borrowers and underwriters to help refinance capital structures. Those create nice 5 to 6% yield or total return opportunities, which we think is attractive, particularly in today's market environment. So 0 to 35%, we're currently around 15% today. That's one strategy. The other two that you mentioned, MUSI and SDSI, so MUSI and SDSI, those are what fit into what we refer to as our income strategy suite of ETFs. Basically, as the name suggests, income is the predominant objective. The second is total return. So SDSI, short duration, 2-year duration, MUSI, roughly 4.5 years. So again, sort of in the short to intermediate term part of the duration curve. And then when you think about the risks, the first one, SDSI, can go up to 35% in high yield, about 20% today. MUSI can go all the way up to 65%. Different market environments create opportunities. In 2021, we were nearly 65%, utilizing, sub-investment grade opportunities. SDSI has gone up to 35%. So we're certainly off the highs of those allocations, but we still find a lot of bottoms up ideas that I think, justify the 20 and 35% allocations that we have today. They go into securitized asset classes. We're finding a lot of opportunities in many of those subsectors. Solar, for example, is one of the newer sectors that we've been finding opportunities in, 6 to 7% yields. Again, short duration opportunity as well. We're not going too far out the maturity curve there. One of our favorite trades that we've really liked over the last year plus has been AAA rated front cash flow mortgage-backed securities. They're prime borrowers, 780 and above FICO scores, mid 5.5% range in yields. Very attractive, $1 million plus mortgage balances. So certainly catering to a high income borrower. And we find that very attractive on a relative basis versus other asset classes, including corporates or emerging markets. So both of those strategies, the income strategies, will asset allocate across the best opportunities in the credit sectors, credit being corporates or securitized, where we're finding relative value in any given market.
So as you go through all three of those ETFs, or I have to ask you, you noted the sleeve, this allocation to high yield corporates. And if we go back to our conversation around the value prop of active management overall, where we started our discussion here, I'll tell you that I have seen the narrative out there that the primary reason fixed income managers have a better track record in outperforming benchmarks than their equity manager counterparts is simply because they're taking on more risk via junk bonds. I'd love to have you touch on that. I think it depends on your perspective, right? Because I'm guessing you would argue this is exactly why you want an active manager at the helm. But I'm sure you've seen this as well when people look at the different benchmarking data out there. Some people will say, again, the only reason fixed income managers have a better track record is because they're taking on more risk. So can you speak to that?
Absolutely. I think it's a great topic. There's two things that come to mind. One is the index levels. I mentioned it before, but I'm going to repeat myself. J and K, HYG, LQD. Those are the passives. Those are the indices. Generational tights and credit spreads, you're getting generic beta. We don't like that. We don't think that in today's environment, changing fundamentals, but also tight valuations justify owning passive strategies. Now, yes, we're talking our book, but I'm also referring to hard math and data that we are near the tights of credit spreads. Okay, so how does that play into your question around high yield? Well, again, I think when you look under the surface and you look particularly in today's market at high yield, double B and then selectively single B rated corporate borrowers, 2 to 3 year final maturity opportunities. We can take a position, we can own 50 basis points of a particular bond from one of those borrowers. Call up the company, speak with the treasurer, CFO, say, hey, Mr. and Mrs. CFO or treasurer, we own 50 million of your bonds. We want to help you refinance your capital structure. By the way, they're yielding 6%. We know that they come due in 2 years. In a year, they become a current liability. That's going to make you sweat. It's going to make you feel uncomfortable in your seat. We would love to help you work with you and your underwriters to help refinance that bond. Creates the discussion with the borrower. We'll then call one of their banks, multiple banks, and often times, and say, hey, we just had a conversation with the treasurer CFO of this company. They're interested in a deal. We own 50 million, and we want to, put our names down for 50 million of a refinancing. The underwriters love it because they'll earn fees. The borrowers love it because they get to keep their jobs, and our clients and investors love it because they're earning an attractive yield until those bonds become refinanced. If you think about that, we're actually creating our own destiny and final outcome by refinancing bonds. Now, by the way, we're not on the hook to buy those bonds. It's a free option for us, as we say. We may not like the pricing, the deal structure. Maybe some of our larger competitors will make some tweaks to the structure and we'll say, hey, we don't like those covenants. Take us out of the deal books. But in the meantime, the bonds that we bought come out at a premium. We love that trade. So that's one thing what I would say where we can create our own opportunities in the high yield market that all parties benefit from. I think there's another element to it too of, hey, why put high yield? Is this a sort of disadvantage to others that may be, purely looking at a benchmark and sort of venturing away from what's purely in the benchmark? I mean, I think it's solely that when you're looking inside a clearly defined benchmark, you're missing a lot of opportunities that may exist. So I think that those two factors come to mind, but there's a third, and in my opinion, being the corporate guy on the team and having done this for 25 years, the most important thing that we're worried about when we look at a borrower is repayment of principal at maturity at par. Right? It's an obvious statement, but that's where you want to do your credit work and your homework. When we think about, let's use SDSI as an example. So SDSI over its benchmark is out yielding its benchmark by 125 basis points. 125. So mid fives versus low fours in the 1 to 3 year Gov credit index. Okay, so Jason and team, you guys must be taking on a lot of credit risk. We are taking on credit risk. Yes, we'll start with that fact, but we're taking on credit risk in an environment where we are trying to ensure that we're not taking markdowns at maturity when those bonds come due. Because if you think about it, the example I like to use is if we're taking a 50 basis point position, we buy something at par, and let's say it gets marked down to 50 cents on the dollar. We've now taken a 25 basis point hit to that yield advantage. Well, if we do that 5 times and we make a lot of mistakes, that yield advantage is not going to look like a yield advantage anymore. We're going to have a return similar to the index. So it's really important that when we're taking credit risk, that we're doing so in a manner where we feel confident we're going to get par back at maturity. Now, we may not hold the bond to maturity, but we want to make sure that we're not taking credit risk that's not worth taking, where potentially we could be eroding that carry environment. So there's no free lunch. You have to do your homework, as they say. And I think that, Nate, to your point on, is it fair or unfair to be, investing in high yield, and is that helping generate returns? Of course it is, but you have to do so in a way that's prudent and you feel confident as investors that you'll earn your return back at par.
Jason, I'll tell you that over the many, many years that I've been doing this podcast, I think what you just articulated there on the value prop of active management, that may be one of the best I've ever heard. I thought that was extremely well done, very clear, and I hope listeners pay attention closely to everything you said there because, again, I think that was very clear in terms of why you may want active management and fixed income. But we'll have to leave it there. Greatly enjoyed the conversation. Again, just excellent perspective on fixed income overall and fixed income ETF. So thank you for joining me.
Thank you.
That was Jason Greenblath, Senior Portfolio Manager and Director of Corporate Credit Research at American Century Investments. That'll do it for this week's ETF Prime. I'm excited to tell you that I'll be at Exchange 2026, where I'll be taking the stage and even recording a live episode of this podcast. This is your chance to join me alongside a community of top advisors and industry experts for a few days of world-class content and unparalleled networking. Secure your spot today by visiting exchangeetf.com. Next week, I will be joined by JD Gardner, CIO and founder of Aptus Capital Advisors, who they recently rolled out the lowest cost buffer ETFs on the market. So we will find out why they did that, and we'll talk about some of their other risk managed strategies as well. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities. And anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.